Hi, Sarah.
Hi, Katie.
It's great to see you again.
Oh, thanks for having me back.
I thought today we could talk about a question that we're hearing a lot from clients and our viewers, and that is, what do I do to manage volatility in the market in terms of my investments?
Right. I think volatility is making a lot of people nervous these days. So I have 6 different tips that I'd like to go through, some good action plans for
Yeah.
our readers, our listeners. Um, Number one, don't get overly emotional with the market. I know it's probably hard because there's a lot of fear when watching your portfolios bounce around in value. And it's hard not to get emotional. But one thing, if you work with a professional, it's going to be really important that you talk with them about your level of concern, because they do have different tools that they can use to help align your risk with your portfolio. So that's the first one.
Great. What
The
else?
second one would be to maintain a long-term perspective. I mean, since we've had this most recent bout of volatility and crisis in the market, it's lasted for a few months, but most of your investment goals, a big part of it should be long-term. So never lose focus of the long-term. You're going to have short-term money needs, but it's also so important that you be focused on the long-term. Number 3 is to rebalance. Rebalancing is so important because in any choppy market, there's going to be certain parts of the market that are going to bounce around more than others. I mean, what's interesting about this market is the NASDAQ and a lot of the tech sector is doing quite well versus a lot of the value sectors like financials or even energy is really not doing so well. And certainly certain sectors like in transportation. So a rebalancing of your portfolio from large growth to like value and then a mix of bonds of the different types of investments is really a good strategy to have, is to rebalance that.
Sarah, can I ask a quick question?
Sure.
If I'm new to investing, how would you break down rebalancing, the buying and selling that happens in that process?
Yeah, so rebalancing has to do with the percentages of an asset class. So think of it like your portfolio is a pie chart, like one big pie. You might have a slice of fixed income. You might have a slice of large companies. You might have a slice of real estate, a slice of international and small companies. So they all make a different pieces. And depending on how your pie looks, really is dependent upon your time horizon and risk tolerance. A lot of times investors will be classified as being aggressive, growth oriented, growth in income, income with moderate growth, um, capital preservation, income focus. So there's different ways that investors get labeled, and the overall mix will be determined differently between those different asset classes depending on their risk tolerance.
That's so helpful. And what's next? What else have you got?
Well, I think it's really the fourth one would be, it's really important to revisit your overall plan, because so much anxiety and concern can come because you're watching these numbers bounce around, and certainly if you're navigating towards retirement. But if you meet with your advisor and actually take a look at the other resources, your assets and liabilities, your different cash flow, income coming in and cash flow of expenses going out, you can actually map out. And many times I've found that that will help to build comfort when you can see that you actually have a lot of options. And many times, even at the lower levels that account values may temporarily be at, it can help build a lot of confidence in our investors.
So
I think
true.
our clients enjoy that. The fifth one would be, don't try to time the market. The market, even though there can be pretty good swings daily, it's not to your interest to time the market. A better strategy would be to dollar cost average. Do you know what dollar cost averaging is?
I do.
You do. What is dollar? Help our listeners understand that.
Dollar cost averaging is where you systematically buy into the market, and over time what that does is ultimately have you buy in at a lower price than you otherwise would. So you're buying more when prices are lower and less when prices are higher. Is there anything you would add to that?
Yeah, that's a great explanation. Also, a lot of qualified plans, so retirement plans through an employer. A lot of times that's a great way to dollar cost average because your money gets deducted from your payroll and then will be sent to the trustee. But you can also dollar cost average and send in money directly. So I like the automatic systems where a system will automatically take so much per month and add it to your investment account.
Mm-hmm.
And then the sixth tip in dealing with the market is never undervalue a recovery. I mean, a lot of opportunity is in the recovery, and it's really important to navigate, to benefit from the tailwinds. And we certainly have had a lot of gyration and things have recovered in the short term, but we're not out of this choppy time. We're most likely going to have a lot of volatility and challenging news that's going to be reflected, and it's going to create a lot of opportunities. So the real benefit will come over the course of the recovery of the market, and that will probably take a while yet to happen.
Well, thank you so much. That all has been so helpful.
Well, thank you so much. It's always fun to be with you.
Well, let's do it again soon.
I agree. Thanks, Katie.